Hello, everyone, and welcome back to another episode of Cryptonomics brought to you by Witham. I'm your host, Mark Eckerle, and today our guest on today's show is Adam Swartzbaugh, CEO at Almond Fintech. Welcome to today's show, Adam.
Hey, great to be here. Happy to have the conversation. Some hot topics right now in the industry.
Yeah, we got some good stuff to dive into today. I guess before we dive into the core ethos of the episode, give us a quick background on yourself, kind of the originations of Almond Fintech and where you are today, and then we'll dive into a couple topics that we want to center today's episode around.
Yeah, absolutely. So the whole reason I got into this space is I just wanted to make the global financial ecosystem more inclusive, on money to move more affordably and efficiently. And I've seen a lot of the downstream effects of not having like good, equitable access to services. So all of it came to fruition. And the primary thing that we do is provide an intelligence layer for cross-border FX, treasury, and payment services. And this is done through a routing orchestration engine that we created to leverage the collective capabilities of every blockchain network, token, and exchange available between two countries to move money in the most efficient manner, delivering the most fiat to the other side, basically in real time. And this is primarily for corporations and money transmitters for a range of use cases, be it remittances, peer-to-peer on the one hand, or it could simply be to take care of payroll. Almond actually utilizes the technology because we get literally about 2% better than our very next best rate quote from anybody else when moving funds from like USD to SGD. So it's we got a pretty diverse application, and it enables companies of all sizes to basically provide a better service to their ultimate beneficiaries. So the result is market-beating FX rates very often, certainly more competitive than the other providers in the industry. You know, T plus zero speeds, usually a few minutes, 24/7, 365, and future-proofed for an industry that is seeing a new layer of infrastructure every single day that we can basically just optimize for. Abstracts the complexity away from global money movement.
Awesome. And yeah, it's awesome to see the innovation cycle come full circle at this point, right? Gone are the days of working on banking hours and you're very limited with all the financial technology out there. So bridging that gap for, call it the unbanked and cross-border payments and making that process a lot more seamless. Going to the mission of what Almond is doing, and how are you guys kind of empowering some of the underserved communities, underserved countries, and figuring out what the real unsolved problems are in the industry that maybe no one is addressing that you guys have identified as your sweet spot? What is, I guess, your specialty there and kind of bringing it home?
Yeah. The approach is like an ecosystem centric one that looks at what are people doing well, and then how do we ensure that they're able to continue doing it well, and then what's not working well, and then find a way to solve for that. So the core problem that was identified is not so much in like the local environments, like in the local markets where are strong financial institutions that have like the trust and credibility and like good operational sort of infrastructure to serve their communities, so much as it is the interoperability between them, and then certainly from a cross-border standpoint, the way in which money moves from one institution to another. And so our goal has been to provide technology infrastructure layer that enables them to do what they're already doing, except better. So we previously went down sort of like the direct-to-consumer money transmitter route and recognized that there are already people that are doing that very well. These companies, these like smaller like money transmitters or large ones or whatever they are, or financial institutions, they're taking care of like that last mile piece pretty well. So let's just improve like the connectivity with other institutions across borders and solve that problem for them. So it's just helps everybody up their game.
And you mentioned it, right? Kind of identifying the shortfalls in the market, right? Or maybe the weaknesses, if you will. And because everyone nowadays claims to be innovating, right? In some form or fashion. So what does actual innovation in the financial technology space look like? And how do you guys position yourselves separately for maybe a lot of the noise, right? A lot of the, call it copy and paste out there, right? That a lot of firms are doing just to kind of slapping fintech on a company. What makes you guys a differentiator when it comes to innovation?
Yeah, there is a lot of noise. This is actually something that the term that my CTO says a lot. Like, there's a lot of noise, and I don't want to contribute to the noise. It's like a fundamental value that we all hold in this company. Don't contribute to the noise. Like, actually do something that's differentiated and adds value. So we spend a lot of time building and less time talking about it. I'm sure there's a better balance, but striking it, like starting to strike it. So to answer your question, more specifically, I mean, there are a lot of challenges right now in the industry, and some uh, there's some energy being put into actually solving those problems. There's, slightly like modify what already exists and what's, it's a bit derivative, put a different color scheme on it and call it good. What we're doing is saying, all right, we've got a couple key ones that actually need to be solved. So for example, one would be that there needs to be like truly dynamic routing across rails, assets in time, and when it comes to cross-border money movement. It's not just about like picking a single exchange or a single stable coin, but actually solving a moving max flow problem where every decision changes the graph, and then applying like this risk aware optimization system to it. So like blending FX liquidity, regulatory constraints into one decision instead of treating them all as like these separate checklists. And so this engine that we created is allowing all of that to happen, bringing together all these variables that basically contribute to what's going to drive the most efficient way of moving money, and then take advantage of it. So I think what it looks like for us is changing like the decision surface versus like just the user interface, for example. So if underneath a Shiny app, you have like a static routing table, like batch files, manual treasury decisions, it's basically a copy and paste solution with better marketing if it's a public operating business. When the core engine starts re-optimizing routes every few seconds, learning from market behavior, and automatically repricing risk and FX, that's innovation. Like if you see that, like that's something that's different. It's a simple test. If you turned off like the PowerPoint, would the unit economics or latency curves like still look different? So this is what we're doing, like real-time dynamic decision-making, leveraging all of the infrastructure that exists, and then processing all of the data around the variables and the drivers to optimize its decision-making.
So as part of that optimization, and there's another piece I'll come back to later that you mentioned about bringing in the stablecoin component, but talking about optimization, and especially in today's environment for about the last 24 months or so, AI is everywhere, right? So we want to figure out how to streamline operations. How do we incorporate that within our firms, within our businesses, in order to make the day-to-day much more seamless? So I guess where, in your opinion, do you see AI impacting the financial technology space, and how are you incorporating that in the business, right? From when you think of a global payment scale, a global payment system.
The main impact of AI for us is in this continuous system micro decisions, like which path, which asset, which venue, right now, a little bit later. So we're using a range of techniques like reinforcement learning. We're using a combination of decision trees and autoregressive models, and then we use something called gradient boost, which just is learning from all of the data points that we're collecting on a second basis as we go through time, and then actually predicting how a decision will modify that environment to yield a different solution in subsequent decisions. So what that looks like actually is, if we need to move $1 million from country A to country B, right now is the traditional concept is push it through that pipe, and then hopefully it all gets to the other side in a day or two at whatever rate. What we're saying is, okay, you're 5, 6, 7, a dozen different blockchain networks, and then on each one of those networks you have 10, 100 bridge currencies. You can move those funds through any one of a number of combinations of those inputs in real time. So there's a lot of different permutations, of course. And then you can say, for this $1 million, I want to split it up into $500,000 through USDT, from USD to MXN, like pesos, or and then the next 400 is going to go through USDG, and then some will go through ETH or Solana, and so on. So you're optimizing the flow of these funds from fiat to fiat through whatever path or combination of paths makes most sense. So this is not just a process application of AI. This is a prediction application. We're determining outcomes that may not already exist. It's not just like, follow this checklist of decisions and you'll get to, the optimal one at the end, which is A, B, C, D, or E, given those contributing variables. We're looking at the whole system with all of the information that we've collected to date, and then predicting how a new decision will impact all of it, and then how the next decision is going to be changed by it. So this is where AI comes into play. Being able to do that without it would be not possible, not at this scale, and not with the sheer volume of data and the computational requirements required to process it all. So this is basically, again, saying like, just for like the person who's actually reaping the benefits of it. It's like a human treasury manager might say, oh, well, we always use USDC on chain X or corridor Y. It's proven and liquid. An AI system, our optimization engine, might actually split that down in 7 different ways through different currencies across different periods of time to give you the best results. To a person that looks like super messy and overcomplicated, but on the P&L, it's the difference between losing 10 basis points on the dollar, or maybe even breaking even or gaining a basis point or two on the dollar. So pretty big impact.
Yeah, and I was going to say, as you boil it down to actually the numbers, right, and you think of what's the ultimate impact of that when it comes to financial statements for a lot of the companies we work with, that could have a meaningful change on the bottom line as they're figuring out their fees, cross-border payment structure, what that could look like. So making sure it's optimized to be the most efficient is a win-win for everyone at the end of the day. When you laid out that example, that whole process that's happening behind the scenes within the underlying technology, what's the time horizon of that happening? Is that's seconds, right? When I go to execute a transaction, it's filtering all of that data to optimize the best possible path forward for me. What does that kind of look like? So, right, building the AI component within the technology, how fast is that actually delivering to your customers?
Yeah, we actually move the money across borders. Like the actual settlement process can be just a matter of minutes. It can be even in the range of seconds. And then there's on either end, you have a payment component. So if you move money from to the destination country, from there it gets paid out. Well, what real-time payments generally looks like today is you have like a little bit of a float there, or a huge float. Actually, what am I saying? Usually it's like 24, 48 hours worth of capital held up to facilitate real-time payments. So real-time payments does not equate to real-time money movement across borders. We actually make the money movement piece very, very fast. So again, in the order of a couple of minutes. Now there's optionality that's baked into this. For example, if you need the money delivered right now, okay, we're going to look at all of our routing options and pick the best path that's going to deliver the most fiat. It's like a spot rate based on way more options than anybody else has.
Mm-hmm.
So you'll get a better rate just by virtue of that feature, the routing piece. Now you can apply some timing optimization engine or timing optimization to it, utilizing the same engine, which says, well, this is what you get right now, but we know what's going to happen 10 seconds from now, a couple minutes from now, an hour, maybe like if you have some patience to wait to have the funds delivered 6 days from now, we can tell you what the best possible rate is that you would get provided that time horizon. So what's actually going on under the hood is we're saying it's Thursday afternoon, you want to move the funds, and at 2 a.m. on Friday morning, you're going to have like great rates. They're going to be better than market. If you wait till then, we'll deliver more. Or if you can wait till Sunday between 1 and 4 a.m. for Mexico, as an example, we consistently get like better rates than the average for the week. So this is just like the decision that basically, these are the decisions that the client can actually make, the company or the financial institution. When do you need it delivered? Okay. Within that period of time, we'll optimize the rate, but we can move it instantly. It just depends on, what the priorities are. Yeah, I think that's it's like the main underlying component of how it works. There's another piece to this, just in the spirit of like cutting through some of the confusion. And that is, with stablecoins, you have instant stablecoin payments, like cross-border payments. It's phenomenal. Like it's just really, really great to see that we're rapidly moving toward that as a solution. What we got to ask is the certain constraints still apply. FX liquidity frames. If you're just moving stablecoin to the Philippines, how many people are utilizing that as like tender locally? Like, do you still have to off ramp it? Like, it's awesome that we'll pay, partner up with BVK, stablecoin payments enabled. what percentage of the population or the recipients are using those stable coins? Have we solved that end point, the off ramp? What is the cost of it? So that's the question asked. Like, is that piece there? This is where, we've also identified a problem, friction point, and this is a solution that takes it end to end and addresses that that cost barrier.
I'm glad you made that pivot towards the end, because that's exactly where I was going next on the stablecoin front. Obviously, stablecoins have been a hot topic for years now, right? And figuring out their sweet spot in the marketplace. And you mentioned some, I guess, constraints, if you will, on the options there. I guess all the good things that stablecoins do, in your opinion, where do they still fall short, right? Because I know everyone, right? A lot of the big banks are rolling out their own stablecoins to make it easier. A lot of firms are utilizing technology in some form or fashion simply for that, to pay maybe international consultants, whoever it might be, employees. So I guess, in your opinion, where are stablecoins still falling short? And can you dive a little bit further into some of those constraints that you kind of previously mentioned?
What we're seeing that's starting to change, but like you said, still falling a bit short, is in the treatment of stablecoin as a product versus plumbing. So we're utilizing stablecoin as like a vehicle to transfer value, such as currency, of course. But this is like the key shift here is stablecoin isn't just like an asset that's speculative like other cryptocurrencies. And because now we've got like a compliance framework for stablecoin for, holding value within the US in a way that like reduces risk that's typically associated with volatility and so on. But when it comes to cross-border payments, like what differentiates stablecoins? Because domestically, for that use case, it's really about like your compliance, and like you have one-to-one reserves available. You're not rehypothecating the funds, and just what you would typically expect from currency. But when it comes to cross-border, I think we're not even beginning to ask the right questions about stablecoin payments when it comes to like differentiation. And I would say like, generally it's been brand so far, but actually what differentiates them is the total route enabled. Like, where is it liquid? How deep is the liquidity? Which jurisdictions and exchanges for it? How predictable is its behavior? The most dangerous assumption is just treating a stablecoin as like a free universal bridge asset. In reality, some are fantastic for specific corridors, and others are not. I've never seen, let me put it this way, like I've never seen USDC and USDT perform precisely the same, like give you the same rate, USD to MXN or any other currency in my entire time doing this stuff. Why? But USDC and USDT are pegged 1-1 to the US dollar, right? So what's the difference? The difference is on the other side. Demand is different. Believe it or not, like people don't demand USDC at the same rate as USDT all the time. There's a lot of variability. And it goes up and down, up and down. Or other stable coins, PYUSD. Like, cool. Like PayPal's got their own stable coin. Great. Like we're going to see more and more and more of this. But if you go to Indonesia, I haven't met anybody that like knew like what PYUSD is, even though it may be offered on the exchange. So if you look at our optimization engine, rank orders every bridge asset for money movement, and PYUSD falls pretty far down. So it's not just like supply side pricing, but it's also the destination side, demand. So like adoption, awareness, so on. And then it's variable, just as any other currency is in that country. Doesn't matter if it's pegged to the US dollar. So it's just something for like consideration, be aware of. If I'm to give a recommendation on this, I would say use them all. I'll be able to optimize across them, know what you're looking for, because there isn't any one of them that's going to work for every use case and every corridor at all times of the day. So why not leverage the collective advantage of all of the infrastructure and just do a single API and integration to an optimization engine like we created. And then you just get fiat to fiat FX rate, the best one. And then you could do what you want with it on the other side, turning to USDC if you're hedging against inflation, volatility, whatever.
It's such an interesting point that I would not have thought about. And I'm sure others aren't thinking about, where it's on the supply side, or I should say the demand side, on the delivery, the destination, like you mentioned, where I'm just thinking I'm living in my bubble. What's the most popular, most prominent? And when I think of USDC, USDT, obviously I think those are like the leaders in the clubhouse, and where maybe companies could be falling short of, they're under the same assumptions, right? So they're not assuming on the delivery side what would be the most popular over there, wherever it's going, and would get me the best rates, the best FX conversions. So that's a good spin on it that I probably would not have thought about until you just mentioned that.
Yeah. There's one last piece to that, which is what does stable mean? So in the domestic
A whole
payments case,
separate discussion.
right. Well, yeah, well, but it's also like, what is risk? Someone asked me yesterday in a panel, like, you could wave a magic wand and like create something that's just like changed at a systemic level to help you do what you're doing. What would it be? It was, uh, it would be that we're all utilizing the same language, the same vocabulary with like common definitions for each word. Like stable, what is stable? Risk, what is risk? Because for stablecoin, there's a preference for stablecoin and cross-border payments because it's stable. The value add of stablecoin in cross-border payments is the speed at which you can move funds. But you don't just need stablecoins for that. If you're going to fiat, you're optimizing for cost efficiency. You have a world of bridge assets that you can utilize in the exact same manner. So like if stablecoin, like the volatility looks like this in this period of time, why would you use Solana if volatility is looking like this in the same period of time? So it's predictable. You're assuming it's risky because of the prediction quality. But if you can move Solana faster, like move funds through the system faster, through the network faster in a particular currency, then the time that this volatility or the stability matters is here. And this is predictable.
Yep.
So now the predictive quality is the same. The risk is the same. So why not be able to utilize all of these options? And when you do, now, if you have stable coins like with a value, like an FX value that looks flat, and you've got Solana in this period of time that's on the rise, and you can predict that's going to continue to be on the rise for the next 3 minutes, utilize the one that's going to get you an upside. And so that's what we end up doing. We just ride the peaks of each wave, constantly rotating between whatever so the best FX by virtue of being able to predict that the variation, their values on the other end.
Yeah, so
As
it's
well.
that. Yeah, to your point, we're not just looking at the currency side of it. It's also the digital asset, the potential changes in market price, right? Because I think when you condense that window, right, you're not looking at a 24-hour window where the price is going to flux 10 to 15% on a given day, give or take, right? You're looking
Right.
in a smaller time frame, 1 to 2, 3, 4, whatever that percentage is in that 3-minute span, 4-minute span for settlement, and you could take that arbitrage. You're taking that difference to the bottom line. So it's a good way to put it into perspective of what the different various blockchains can offer and the tokens built on them.
Yeah, 100%. Short enough timeline, every currency is stable. So there are variations that occur across a longer period, though. Like we know, like I can tell you that, like the value of like U.S. to Philippines, sticking with that, XRP, it performs really well around like 2-3 a.m. Compared to how it performs the rest of the day. And so you can actually say these currencies perform better around this time of day. Like you would actually want to wait longer period because you're predicting an upside that's actually further out than the few minutes it takes to move currency through the blockchain like as fast as possible. Like there are like higher level dynamics from a time span standpoint. But anyway.
Yeah. Okay. I got two final questions. One's probably easier than the other. I'm going to start with that one that I think are fun to wrap up with here. What has been a smart move from one of your competitors that made you rethink a business case, a strategy, a go-to-market move? What has kind of forced your hand a little bit that said, okay, I got to audible or I got to pivot, that you were like, kudos to XYZ firm for doing that?
Yeah. I think a lot of them like typically pertain to distribution hacks or something, or like the messaging around the product offering or what the feature can actually do, and so on. But there's a new one that I really like. That's it's an effort to kind of move in the right direction, but it's like sort of it's like a half step to nowhere, and that is again, great firm and so on. So Visa is working with stablecoin payments now, right? And so adoption's going up, but big firms can't just like jump headfirst into everything. You're mitigating risk. You're just learning a little bit and just controlling for the unknown until you vet things out. But one of the things that stablecoin payments, cross-border payments, stablecoin treasury solutions enable is like real-time delivery of value. And of course, in our model, like we're going fiat to fiat, all this happens, in a matter of minutes. One of the key things that improves or that provides cost efficiency is the simple fact that you don't have to keep large capital floats in another country because you don't have to. So, like, if you've got payments that need to be made over the weekend, good luck with that if you're using traditional routes, banking hours apply. So you need to stock up on capital in country and then pay out of that throughout the weekend. So now you're putting 48 plus hours worth of capital up front in another country. And whereas with stablecoin, you can get it into somebody's account anytime, 24/7, 365. For us, we optimize it right into fiat into their account. Now, for Visa's positioning on this is to provide stablecoin payments pre-fund in stablecoin. So what you're doing is you're pre-funding, like you're doing the same thing. You're putting up your capital into a stablecoin account, and Visa then will facilitate the payments for you. The reason that this like kind of made me not so much rethink our model, but like just rethink our messaging and how we're approaching the competitive landscape is just how this is like kind of it's not an actual material change. You're still like requiring a capital, like an upfront capital flow. And therefore there's a cost associated with it because you're not putting it into other applications. Sure, you'll need to keep less in that float because for this obvious reason, you can move it quickly. But the reality is that you can keep money in USD in your own account. And then when you need to make a money movement, we can move it through, if you want USDC, move it into USDC, transfer and deliver it in a matter of minutes. Or if you want fiat, actually, we can go USD to USDC or USDT or whatever it is into fiat. So like, let's keep our focus on the problem we're trying to solve. It's the speed, it's the cost efficiency. And let's just be wary of the halfway solutions that aren't actually addressing the core requirement for some of the and beneficiary.
When you see the big institutions come in there, it's almost like the fine print of, all right, well, you got to make the whole full upfront capital allocation. And still, you're out of those funds as opposed to what you're suggesting that you have where you get to hold on to your money a little bit longer, right? So you can kind of hold the reins further, which is interesting to see, right? Because they make all the flashy big headlines, but what's underneath the hood?
Yeah, basically. And so again, like this is all positive movement in the right direction. Those flows will be, smaller and money will move more efficiently, but we have to like just kind of really recognize like what the power of this infrastructure is. And the sooner we get on the same page, the reason I'm motivated to make this happen is sure, I've got a company and I want it to be successful, and we built this phenomenal technology that addresses these problems at like the real core level in a meaningful way that will only continue to improve as there are more blockchains built, tokens minted, and exchanges open, really future-proofed. But I just want us to like get it there as soon as possible versus half steps when we're not really necessary. And ultimately, the reason is because it has a big impact, really big impact. Cost sensitivity for individuals sending money home. You ultimately don't want to be losing 3, 4, 5, 6% on the dollar. I mentioned it like early on. Almond uses this technology for our own payroll, and it saves us 2% over next best option. Like payroll for this company, like what it's just brains. This is what we've got. This is our asset, and so it's payroll for an early stage company in the grand scheme of things. Like saving 2% month to month just by virtue of using the technology well or properly and optimizing its flows, like that makes a big difference for a small company. Any company like of a small size can benefit from rates that only like a Goliath would typically be able to get or provide to those with volumes in the 50, 100, 200 billion dollar a month range. So I would really democratize how money moves, and it'll be good for everybody. That's why I just want us to get there faster while also, properly managing risk. But hey, here's a solution that just mitigates risk down to basically nothing because you have so many options, so many redundancies. Like you don't just shut down a blockchain breaks, token loses all its value and exchange closes. This thing's designed to route through all of the contingency paths available. So I think it's like the actual safest approach is something that optimizes across everything. Pretty excited.
Risk optimization, as well as 2%. Those move the needle significantly, to your point, regardless of the size of the company. So everyone should keep that in mind. My final question, what's the What's a risk in your industry that people are kind of ignoring, or a weakness, if you will? Maybe people aren't addressing head on. Maybe it's not as flashy as certain topics, so people don't want to face or cross that bridge. Is there anything that comes to mind that you think is a risk or a problem to the fintech industry?
I would just say that like it can be a dangerous belief to you know to think that just because systems are more automated, maybe they're automatically more resilient. So one of the like we're talking about AI previously, I think that the common applications in processes improvement and so on, as long like what we really need to do is ensure that we're still solving the right problem. So some things may be happening more efficiently, but we could still be solving the wrong problem, delivering a result. It's not the optimal result, just more efficiently. So like in the stablecoin example, like cross-border stablecoin payments, are we still solving the ultimate problem, even with all of this, like the efficiency applied to it and a lot of the automation that's happening, much of which is AI driven? Are we still getting it into people's hands in locally usable fiat in a cost efficient manner? And if we're not, then okay, let's think about how we're actually improving the systems, not just like continue to optimize the automation alone. Like this is like using AI for process versus like maybe prediction or some of the more problem solving oriented tasks that can actually make an impactful difference. Yeah, I would say that's probably the biggest one right there.
Awesome. Awesome. Definitely. Yeah, it's going to be interesting to see the developments. We didn't even touch on the regulatory environment, but no, this was great. We had a great discussion today. I appreciate you taking the time to walk us through a lot of these complexity challenges and things that could be the needle mover for companies, right? That could really significantly impact the bottom line. So, Adam, I appreciate you taking the time today. Where can listeners go to learn more, follow Almond and yourself?
Almondfintech.com is our website, LinkedIn, etc. If this is something that you would want to utilize, you want to benefit from, I mean, reach out to me. If you made it through all the way to the end of the podcast, I guess that's a good sign. So my email is adam@almondfintech.com. We can very rapidly like deploy this solution to any like corporate treasury or payment oriented institution that's just trying to be more efficient and resilient and future focused, like they want a future proof solution. So just feel free to reach out. I'm happy to help.
Awesome. And with that, thank you, everyone. Thank you, listeners. And that concludes another episode of Cryptonomics.